You're watching Investor's Guide on ET Now. Thanks for staying with us. Dhirendra is with us as well in our Delhi studio, and it's time now for us to do our product review of the week. And this week, we're looking at the Reliance Long-Term Equity Fund. Avan is here with an introduction into that fund. Avan.
The Reliance Long-Term Equity Fund started in 2006 as a close-ended mid and small cap fund with an automatic conversion to an open-ended fund in 2009. Though Reliance Long-Term Equity Fund has failed to impress investors. It was the first close-ended fund from the Reliance stable. It started off with a proposal to generate long-term capital appreciation by investing predominantly in small and mid-cap stocks. But it has only managed to give its investors 5.92% annualized return since its launch, which places it far behind its peers. In the last 1 year, the fund has lost 22%, with its category average lost only 17.5%. Let's take a look at its portfolio. And like mandates, it invests 94% in equity corps in mid and small cap stocks, preferring healthcare, chemicals and financials as its sectors. But the NAV puts the entire report into perspective. If you invested 1,000 rupees in this fund when it launched, you would have 1,328 rupees today. But if you're still holding this fund, is it time to move on? Let's find out.
Thanks, Avan. The Reliance Long-Term Equity Fund was supposed to give its investors the long-term benefits of investing in small and mid-cap stocks, but it's not managed to do that. And to add to that, it's had a really rough year this year. What are you making of its performance right now? Are you advising investors at all to go anywhere near this fund?
No, I would say that this fund has been extremely disappointing, and not that this category has too many inspiring funds. And also, if you look at the life of the fund, launched in December 2006, 1 year ahead of the market surge, market decline. So it did well in that period. But I think it assumed risk, which was soon to be visible in its performance. And it is an extremely mediocre fund compared to most other mid and small cap fund. And looks like in the past 4 years its mediocrity is reasonably settled in. This fund will do well again as and when the market turns around and market gets overheated, and that's the time when this category and the kind of allocation this fund, or the kind of stocks this fund emphasizes in its portfolio, will start showing performance. But I don't know how long that will take. And even compared to most other mid and small cap funds, the category it falls in, there are many other, plenty of other superior options.
All right, so for investors who are in this fund already, obviously we're recommending that they pull their money out. Could you name a couple of those superior options that they can put their money in instead?
IDFC Premier Equity, ICICI Prudential, Discovery, they're just a good choice. Likewise, if you're looking for a conservative mid cap, maybe Sundaram mid cap, not this fund.
The last time we talked about this fund, Dhirendra, you gave it 2 stars. Have you changed your stand right now, or is that still your rating of the Reliance Long-Term Equity Fund?
Yes, I think that over a period of time it is a promising fund. But this kind of fund, given its behavior, this fund should not be. I keep suggesting that you should choose fund which you can manage. You invest and you forget about making frequent changes. This fund doesn't fit there. So it remains a 2-star fund, an avoidable fund.
2 stars there for the Reliance Long-Term Equity Fund. Now, did you know that when a mutual fund agent sells you a product, he makes a transaction fee from you, but he also makes a commission from the mutual fund company? Now, the interesting thing is that different products will have a different rate of commission. So he might be pushing a product that will earn him a higher amount. So as a customer, you need to make sure that when someone gives you advice on an investment product, that advice is in your best interest and not in his. So how do you do that? Well, Swati has put together a quick list of 5 questions you can ask your agent to make sure the product that he's selling is the right one for you.
Manish Joshi has a common problem. He suspects his mutual fund advisor has been recommending investments that are not in his best interests. Now there's a way for both Manish and for you to make sure your agent never missells a product to you. All you need to do is ask your agents these 5 questions before buying the product. Your first question, is this an equity, debt or balanced fund?
First, set your goal and then only invest. When you approach a financial planner, he will assess that what risk appetite you have and what is your objective of investment. Based on the different investment objectives, he will recommend your products.
If that financial goal is likely to occur in 2 to 3 years time, then you would use debt as an asset class, and then there could be different vehicles like do directly FD bond or take a mutual fund as a route. If that event or a goal is likely to occur after 7 to 9 years or 10 years, then choose equity as an asset class. And for an interim period, make combination of both debt and equity, or probably you may only want to choose a balanced fund.
Your second question, how does it fit into my investment strategy? Each new investment you make should complement your existing portfolio and fit into your investment strategy. You do not need more than 5 to 6 funds in your portfolio.
So is this something for the long term and the really long term, diversified large cap for example, or is this something which is more appropriate for current market situations? For example, volatile markets, you might have a defensive product and therefore defensive strategy. But once markets go back into, let's say, a longer term phase, you might want to review. So how does this product actually fit within the current investment strategy is a question you might want to ask with this fund.
Your third question, what is the 5-year track record for this fund? Also make sure you compare those returns to the benchmark and returns of other funds in the same category.
A fund which has done well over the last 3 years, do we believe it will continue to do well over the next 2 or 3 years well, or do we think that the last 3-year performance has been a bit sporadic because of specific factors or specific risks that the fund manager took, and it may not be repeatable? So we are looking for consistency, we are looking for discipline in fund management strategy, we are looking for repeatability of performance.
Your fourth question, what are your commissions on this fund? Regulations allow you to ask your agents what he stands to earn from the sale of a product.
Mutual fund companies pay something upfront from their own profit. But it's important for you to ask that question and understand that where is the earning coming? 2 ways. One, if he's not earning really good amount of money, then you want to compensate him, because end of the day, if he's not earning, then he'll either missell it to you or he'll kind of churn your portfolio. Second is, if he's really earning a lot of money and if the scheme is not worth, then also you want to know, because he's trying to push a product where there is more earning.
And finally ask him, would your agent or your fund house give you service after you have bought the product?
Say in future you want to do a change of address, or if there is some change of contact details or some regulatory requirement comes like KYC, will he be there to help you? So A, you want to know the price, B, how are you going to pay the price, and C, what all services you can expect for paying that price.
And that's not all. It's important for you to know your advisor's background, what qualifications he has, and what clients is he handling. It's like a job interview. Meet at least 3 or 4 advisors, ask a lot of questions, and then pick one.
Right, 5 questions there that you can ask your mutual fund advisor. Dhiredhu, you speak to advisors all the time. As an investor, while I'm buying the product, what should I keep in mind?
I think, before you start questioning your advisor, I think investors should draw up a set of questions for himself, because that is the best help an investor can do. Be ready with, why are you investing, what is the time frame, and when do you need, the time frame is the most crucial part, and the goal, if you have any tangible goal, and whether that goal is a negotiable one or a non-negotiable one. For example, buying a house could be can be a little negotiable goal, in the sense that you plan to buy your house in 5 years, you can well buy it in 7 years. If you achieve your, a certain target amount, you can well prepone it for 3 years, after 3 years. But a child's education cannot be negotiated. That need will crop up on a day, and you have to go about executing it. You need the money then. So I think, having clarity on this front is crucial. And then asking the very basic question, which is, what is the cost? What is the track record? What are the other options? and the reason why it is being recommended in the first place.
All right, so there you have it. Questions to ask your agent and questions to ask yourself before you make a mutual fund investment. Dhirendra, thank you so much for joining us on Investor's Guide and answering our questions. Remember, if you have questions for Dhirendra, there's an email ID at the bottom of your screen where you can write to us. It'll be our pleasure to answer your questions on the show. Coming up after the break, Suresh Surana is back with us to answer your questions on tax, so don't go anywhere.